Okay. Now there are, so once you have got an understanding, now look at some jargons. Now different types of dosas will come. Okay. First thing, different types of conventions. Actual means 365 days and actual number of days. Then the other convention is 360 days. Street convention. True yield. Government equivalent yield. Simple yield. Current yield. Okay, coupon divided by price, flat price. Okay. Now, street convention, generally, okay, they will, the street convention is basically you will account or factor in the holidays, Saturday, Sundays. Because settlement, if after 3 months means it falls on a Sunday, that day the settlement will not happen. Trading day only settlement will happen. So street convention will be considering those holidays and all. True yield is without considering those holidays. Okay. Government equivalent yield means 360 you are converting to actual. All these things are there in your material. Go to this chapter LM7. I think there is one table where they are talking about this. They consider all these holidays and all to calculate the number of days and all. So table LM7 where they are talking about this. Check. Read it out quickly. That we know. Next. It does not contain. Okay, bank holidays means whatever public holidays are there. Then it does not consider. Read it again. Street convention. True yield.
True yield is higher, never higher than street convention means due to readily time to pay. Government yield measure that restate the yield to maturity based on 30, 360 day count, one based on an actual day count. It is used to restate the buyback on a corporate bond to obtain the spread over the government rate.
Okay, what does this mean? So it converts to actual, right? Generally, corporate bond is 3360. Okay. Now, if I have to convert the corporate bond to a government bond, not convert basically to compare, right? A government bond will be more riskier. Yield on a government bond will be high, or yield on a corporate bond will be high. Corporate bond will be high. So there is this risk premium will be attached. How do I compare? Because this government bond is actual treasury. What are government bonds here? Treasury bonds, right? All things. Okay. So government bond is on actual. Corporate bond is 3360. So you are converting the corporate bond to actual to compare. Okay. Simple yield. Japanese. Then current yield. Current yield not given. What is current yield? Current yield will be there in the previous chapter. Basically, your coupon by flat price. Okay, so this convention you should know, right? Read 2-3 times, you should be able to remember and understand also. Okay. Now let us look at different types of yields. First, callable bond. What is a callable bond? The issuer can call at generally not any time, at certain specified dates. So call 1, call 2, time 3, time 4, something like that, right? So, but at different dates, different timelines, the call price, okay, will be different, right? If you call on maturity, the price is mature value, that is 100. But if you call before, let's say after 1 year or say after 2 years, so the price at which you can call after 1 year or the price after which you can call after 2 years will definitely be different. From the year 1 call price will be different, year 2 call price will be different, year 3 call price will be different, year 5 call price will be different, and maturity call price will be different, right? So it is at the discretion of the issuer when to call, right? When to call. So you have this list of different prices. Based on different prices, I can calculate the yield. Simple calculation, right? So when I calculate yield to call 1, yield to call 2, the your future value will not be 100. Your future value will be that call price, right? The only difference is maturity value will not be 100. Maturity value will be that call price, right? And based on that, you calculate different yields, right? First call, how much yield? Second call, what is the yield, right? And let's say there are 4 calls, okay, and 4 different yields are there. Which call the issuer will decide to call? There are 4 different call dates are there, 4 different yields are there, right? Today itself we know this, right? Today itself the issuer will try to call when? Right, when the yield is low, so what will happen? So that is called as basically the yield to worst. Whichever option is giving the lowest yield, he will call. Right, the lowest of the sequence of yields to call and the yield to maturity is known as the yield to worst. Right, objective is to provide most conservative assumption for the rate of return. Yield to worst is what he will call generally. Right, so yield to worst is not given. Yield to worst will be calculated. Different calls will be calculated. Based on that, whichever is the lowest will be the yield to worst. Okay, yield to worst, very simple. So in an exam scenario, in the questions, different prices will be given. You have to calculate the yield. Whichever is the lowest, you will say this is the yield to worst. Okay, simple. Now there is something called as one simple thing is, risk-free rate plus risk premium, right? So risk-free rate is generally for bank securities, government securities, and risk premium is for anything apart from that. As the risk increases, the risk premium will also increase, right? A corporate FD risk premium is higher compared to a bank FD, right? A corporate bond is higher, right? Similarly, a corporate stock, underlying stock, is much more higher. The risk premium increases. Now, there is something called as benchmark yield and YTM. Okay, what is the benchmark yield? Benchmark yield is generally your, you can say, risk-free rate. Everything is based on our benchmark yield, right? See, when you say risk premium, right? You say the required rate of return on my equity is 15%. Where is this 15% coming from? Basically, there is a benchmark. My risk-free rate is 6%, 7%. Plus, then my other premiums, right? So based on the risk, I am attaching this premium. But there is some benchmark for you to stand, right? On that, you are standing and telling minimum 6-7% is required. That is called benchmark yield. Okay, yield spread here is nothing but your risk premium. Yield spread is the difference between the YTM that you want and the benchmark yield. Okay, yield spread difference. Able to understand? Keep writing these things. These things are there in the book, but the more you write, you'll be able to understand very simply. Yield spread. Spread means what? Difference. Right? There is nothing but your yield spread is nothing but, even though we cannot use the word risk premium here, but it is your risk premium. Risk-free rate plus risk premium is equal to my required rate of return. Where did you see this? APM. Right? Same thing is the difference between my required YTM, okay, and the benchmark yield. Okay. Now your risk-free rate, okay, or the basic rate, right? It captures. It is made up of what? Your interest rates, general interest rates are made up of what? And the not risk premium. Inflation. Economics. So we went to portfolio management, into equity. Now we are going to economics. Your rate is made up of what? General interest rate, real rate plus inflation. So the benchmark rate, it captures the macroeconomic factors. Little bit of economics. I think you would have seen this in your economics. The benchmark rate, the base rate captures macroeconomic factors. Right? Risk-free rate plus your inflation plus your real rate. Okay? The spread. What is the spread? The difference. It captures the risks. What are the risks? Your liquidity, credit, and various risks are there. Your book is talking about these three. It captures the bottom up. What is the bottom up? At the base level, what are the risks? Your credit risk is there, depending upon who the issuer is. Liquidity risk is there. The taxation risk is there, whether it is high tax country, low tax country, all those things. Okay, basically, what is the spread and what is this benchmark made up of is what we are discussing. Right? So, on the rent security, basically, this is your government bond. Recently issued government bond based whose interest rate we are using at benchmark rate, also called as treasury bonds. Okay, the jargons, we are trying to understand the jargons. Treasury bonds means more than 1 year maturity. T-bills generally less than 1 year maturity. T-bill is your money market. This one is capital market. Okay, benchmark rate that we are talking about, benchmark yield, is based on the government bond YTM. Okay, now government spread. What is this G spread? Nothing but this spread. Okay, so now different types of dosas are coming. Okay, one is yield spread, G spread, generally called as the spread. Which spread? The spread is generally called as G spread, representing the credit and liquidity risk. This one, credit, liquidity, and tax risk. Okay, this spread is called as G spread. To calculate, compare your bonds YTM to the government bonds yield for the appropriate tenor. To calculate this G spread, okay, because we have one more spread, Z spread. Z na Z spread. That will come in some time now. Right? Mysore masala dosa is different, and masala dosa is different. So G spread, government spread is nothing but simply the spread, the risk premium, which is representing your credit and liquidity risk. Tax is also there. All risks will come, don't worry. To calculate, compare bonds, your bonds YTM, your corporate bonds YTM, or any bonds YTM to the government bond yield, or which is also called as spot rates for the government bond, for the appropriate tenor, 3 years, 4 years, 3 months. Sorry, generally the tenor means the reset, 3 months, 6 months, that tenor. G spread, understood? G spread is nothing but at high level you understand the spread between government bond, the risk-free bond, and the risky bond. The difference risk premium is your G spread. Now I spread. Okay. Now Hyderabad masala dosa. Okay. This you can keep separately. This is not interconnected. Okay, this is a separate spread. You can keep it. What is this? Basically, this is for short-term money market securities, short-term market reference rates. Okay, wherein you are using your what currency swap rates? Yes, currency swap rates. The spread over the currency swap rates. Okay, against a short-term your LIBOR-based securities and all. Okay, for what? Basically, your corporate bonds YTM less the swap rate. This is not government bond here. Corporate bond YTM less the swap rate for the appropriate tenor. Meaning to say, very simple. The interpolated spread you can say between, let's say, real bond versus index bond of Indian currency. Index bond, benchmark bond. Okay, that means what is the rate, standard rate for INR currency loan or INR currency bond, right? What is that rate versus Reliance Industries bond rate? There is also a difference, right? The difference is this spread. Both are corporate bonds only, right? The used to measure credit risk, higher the spread, higher the yield, right? So let's say now you have this index currency, index rate, okay, or the swap rate for the same tenor and same currency. Let's say it is 9%. Okay, RAL bond YTM is, let's say, 10%, and you have another some random company ABC bond is 15%. Obviously, RAL's credit risk is less, so the spread is less. This random company credit risk is high, so spread is high. Getting it? Swap rate basically interest rate swaps for the same tenor and the currency. Clear? So you can keep this Hyderabad dosa separately. We were talking about masala dosa here. Now we will go to real Mysore masala dosa. What is this? So what we were talking about is only one rate at a time, right? So far now, yield measure for your fixed rate we are talking about, floating rate we have not yet come. I am not very sure if we can do it today. Fixed rate bond we are doing. Okay. Now your bond can be for 6 years, 10 years, 5 years, right? Any period, right? When you are using the discount rate to calculate the present value, that is based on today's factors, correct? The factors after 6 months will change. Factors tomorrow also will change. You never know when our laptops will explode. Yesterday pages exploded, right? So the factors will keep changing. So what the economics says is, or what the logic says here is, you cannot use one discount rate for 10-year bond, right? That is why I think if you have studied probably yes, in bonds TVM, multiple discount rates. To do one calculation, you use multiple discount rates. Year 1 discount rate is different. Year 2 discount rate is different. Year 3 discount rate is different. Why? Because I cannot use one required rate for 10 years. Right? The factors will change. So we use multiple discount rates. Right? Correct? So that means multiple discount rate. These multiple discount rates on my corporate bond, right, will form a curve. Right? So you have seen interest rate curve. Right? Interest rate curve, basically interest rates for different tenors. 3 months. What is the 3 months rate today? What is 6 months rate today? What is 1 year bond rate today? What is 2 year bond rate today? What is 3 year bond rate today? Right? What is the 10-year bond rate today? So if you float all of this generally, right, you will have the curve going upwards. Right? Higher the maturity, higher the yield, generally, right? Higher the risk, higher the yield. So the bond will actually, the curve you can check in your book, it will go like this. Okay, it will not come down, it will go up like this. Okay, so that one corporate bond yield is there, then government yield is also there, right? So there is a gap between these two, right? Which gap is expected constant? A constant gap, the constant spread is called zero spread, zero volatility spread. The spread will not be constant in reality, right? The spread will not be constant. But if I assume that I want my risk premium is 5%, right? I want 5% more than the government bond, right? Then how should be my interest rate curve looking like, right? So that graph, check in your material, Z spread. Once you see, you'll be able to understand. That one only. Done, zero spread. You see, your the lower curve is what? Government bond, or the basically the on the run security benchmark yield, right? And the curve at a higher thing is your corporate bond yield, right? The difference between these two is your constant spread. A constant yield spread over a government spot curve, that is also called a spot curve. This, which we'll see in the next subsequent chapters, right? Spot curve. What is the spot curve means? Interest rate curve, which is plotting 1 year interest rate, 2 year interest rate, 3 year interest rate. So when I plot this in the graph, I will see this curve. 1 year interest rate, generally in the normal economy, 1 year interest rate, let's say 6%. 2 year interest rate 6.5%, 3 year interest rate 7%, 10 year interest rate somewhere a higher number, right? Not like exactly offset, different, but it will keep increasing. That is why the curve is going up or coming down. Going up only. Good, thank you. My economics is good. Interest rate curve generally will go up in case of US. So what happened 2-3 days back? என்ன ஆச்சு எவ்வளவு வாங்கின நீ வாங்கலையா நீ வாங்கலையா அப்போலாம் வாங்க மாட்டோமா when the market is silent I will be active, market is active I will be silent. So what happened, interest rates were increasing generally for US 5% 6% and all is a big thing. 1% 2% only I have seen, but in last, especially after COVID, the scenario changed, right? Inflation increased a lot and interest rates also increased, right? So basically that rate cut is what? That rate cut is for on the interest rate for a certain duration, right? There they said, okay, we'll cut down our interest rates, right? So the interest rate generally in the normal economy, interest rates will increase, right? So that is why this curve is going. What I want is, I do not want the government bond yield. I want risk, then I'm looking at a risky bond yield. I want 2% extra. I want 200 basis points extra. Spread is generally referred in terms of basis points. How many basis points is equal to 1%? 100. I think we have discussed this. Right? Spread is generally on BPS. I want 200 BPS extra, 300 BPS extra, 50 BPS extra. Then you get this another curve. So this constant spread is called as the spread. Without volatility, whichever way my government bond goes, that way only I will also go with constant difference. That is the yield that I want on my corporate bond or on my risky bond. I wanted to do some calculation on this. Okay, work out this question. So what is the doubt here? 4% annual pay bond is currently priced at 105. Okay, it has 3 years to maturity, callable at a price of 102.5. What is the YTM? What is the YTM? Have you calculated the YTM? How much is YTM? YTM we did calculate or we did not? How much is the YTM? 2%. 2.2 what? Hey, I do not know answer. Don't think that I know the answer. I'm asking you guys. If I know the answer means it will not be effective. Only when I do not know the answer, we can have a good discussion. Then yield to first call is how much? Okay, 1.4286. Everyone got this number? Then 6846. Okay. So what is the confusion now? Hey, this calculation, if you are not getting correctly, means I cannot do anything. This is simple yield calculation. What is the answer? The yield to first is the bonds, lowest yield, right? So which is the lowest here? Yield to first call. That is the answer according to the numbers you have given. You are having it out here. Yield to maturity rate per annual pay bond. 3 years to maturity, right? 3 PMT is 4, PV is 105, 100, 0. Right. Then yield to first call. Yield to first call. How do you calculate the yield from here is how many years? Years, right? PMT is 4. This one is 102.5. Enapa? Correct, Dana? At the end of 1 year, you are calculating the yield. Or you are calculating the yield assuming the maturity is at the end of the first year. What should we do? Yield to first call. That means what? The bond will be called at first year. When are you calculating the yield? Today. So you have 3 years maturity. Then you have what? 2 year maturity. You have 1 year maturity. First call is how many years maturity? 1. Then rate should be, this tenor should be. Then, but you guys told me 1.4286%.
PV is 105 and FP is 102.
I'm sorry. Yeah. This is EV is correct. 105 and correct? Right. Sorry. One is how much? 100.5, right? EV is minus 105, and that called at the end of year 2, that is future value. So 2 years. Okay. So which is the worst yield to first call? Okay. Yes. Okay. Can we move on? Okay. Now that was only a filler because I was trying to get some questions for your Mysore masala dosa. Here is your Mysore masala dosa. Yes. See, I'll share the file, right? You should focus on writing your own notes when I'm discussing, like whatever examples I'm giving, lot of examples I cannot be putting here, right? So this I will share. You focus on what you are getting to understand, you note that. Okay. But just because I'm sharing the file doesn't mean that you will keep quiet and keep looking at my face. Yes. So now what is this Z spread? We said a constant spread over the government yield. First point. Second point, we said I cannot use one single discount rate to calculate the present value, right? So we need to use multiple discount rates to calculate the present value, right? For the appropriate tenor. So a bond has two cash flows, so and so, so and so, and the 1 and 2 year benchmark spot rates. Benchmark is what? Government yield spot rates. That means today. Or for 1 year it is 3%, for 2 year it is 4%. Okay, and the spread is 6%. Okay, calculate the bonds price. SAR means what? A bond has two future cash flows. SAR 5 means what? It's a currency. You're telling it is cash flows. See, it is very easy to not understand, right? SAR, she was telling semi-annual rate. Okay, that is why they have specified clearly it is future cash flows. Okay, SAR, which currency? She has gone to Kenya and all, so she knows Masai Mara and all. South African rand, 5 in 1 year, that is my coupon is 5 in 1 year and 105 in 2 years, basically maturity and the coupon. Okay, and they are giving 1 year spot rate from today. 1 year yield today is 3%, on which on government bond. 2 year yield on a government bond is 4%. Okay, so use this number, calculate the price and go home. You have to use TVM function in your calculator. Actually not required. You have to use cash flow function, or you can use manual TVM function. Manual formula also you can use. A is equal to, that also you can use. Different discount rates. I need to calculate present value, price. Year 1 it is different, for year 2 is different. So to calculate year 1 cash flow, I will use year 1 discount rate. Year 2 cash flow, if I have to calculate on year 2 cash flow, I will use year 2 discount rate. Add spread to that. So what will be my effective year 1 discount rate? 3 plus 6 and 4 plus 6. If you have done this, then do the next one. I'll be back. Okay, so basically multiple cash flows. So do not use TVM function. So you can make a list when to use TVM function, when not to use TVM function. Definitely in these cases, don't use TVM function. This is much more easier and straightforward. Not complicated. TVM function will become complicated here. Okay, n is equal to 2, n is equal to 1, interest rate insertion, right? That will become complicated. Can we do this quickly?
So you know that we can do this using cash flow.
Cash flow function also you can. That is much more again complicated. That is what I did. Cash flow function, you may not be able to do it. You'll have to repeat the calculation. Why? Because different IYs are there. Okay, so that's a good thing that he asked. So now what I should do, like the exam, so at the practice stage, it is not only sufficient that I get the correct answer, I should also try to figure out which is the easier way to do it. Then make a note that, okay, in wherever this concept is explained, tell that in there you mentioned use this approach only, do not use these two approaches. It is time consuming or it is complicated. So someone may be better off here with using TVM calculation. Someone may be better off with this manual calculation. So that is your lookout how you want to do it. Right? Okay. This one can we do? Done. Arbitrage or if, okay, for now you ignore arbitrage, just say highest price. Yes, calculated. What does this mean? This means that today, if I invest in a 1-year bond, the rate is 3.75%. Today, if I invest in a 2-year bond, the rate is 5.5%. 3-year bond rate is 6%. That is what it means. These are all the rates that I'm seeing in the screen today. I do not know. So year 1 cash flow, you will, how much is the year 1 cash flow? 5, right? Then 5 and then 105 divided by 1.1 plus 0.0375 plus 0.0055. Okay. Okay, follow this approach when you are learning, even in the exam also. Exam also, you should follow this approach. You will get pen and paper. You should do this. Right? 55 basis points. Okay, similarly here, what will I get? 0, what? 515, the whole power. This is whole power. Okay, and then third one, 1.00, 1.06 plus 0055, the whole power 3. Right? So this will give the denominator as so the present value is this plus this plus this plus 9 is equal to 5. I'm surprised why everyone is silent. 5 divided by 1.043. Right? So it's equal to this plus 96.07. Right? This is your calculation of a price using Z spread. That is what we used here, no? 5 cash flow. One second. Yes.
So then why can mention that I just RP price? RP price.
What is okay? So the highest price that an investor should be willing to pay is very simple: present value of future cash flows. For anything, value of any asset is what? Present value of future cash flows. That is a fundamental rule, right? So the highest price that I will pay for this asset is whatever is the present value of future cash flows, which is what I have calculated. Right. Now, what is this arbitrage? Basically, if this is available for some other rate at some other market, then that difference is arbitrage. Getting it? Now, for this, calculation is required or not required? Not required. Required or not required? Required. Getting it? Z spread, right? Z spread is a constant spread over multiple years, right? When we are using, basically, generally, this is what we are discussing so far in LM6, LM7, everywhere. We are talking about a fixed rate bond. Okay? A corporate bond. How do I measure the value of that bond? Ultimately, if you see here, so my corporate bond is a 3-year bond, right? So what I'm doing now, I'm taking different discount rates, and because my bond is having risk premium, or I want more risk for a better yield, that risk premium is Z spread, a constant spread on the government bond, on the risk-free bond, on the treasury bond, on the benchmark bond, or on the spot rate bond. That like multiple jargons we can prefer. Which rate?
The discount rate will be fixed.
The discount rate is changing no every year. That is what we are doing no. The Z spread is same, 55 basis point. That is the spread over the benchmark yield. Government bond and the corporate bond. 55 basis points. important 55 basis points. How I am using that 55, how I am inputting that number in the calculator is also important. 55 basis points is not 0.55, it is 0.0055. Clear? Where 5% is not corporate bond rate, 5% is coupon rate. No. Where is the G spread here? What is G spread? That is for one term. Correct. G spread and Z spread. Similar. G spread is only for one period. If you are using one YTM, but we are not using one YTM, we are using multiple spot rate, right? So that multiple tenor is Z spread. 5% is coupon. 5% is not here. I know. After looking at so many different things, finally you are telling what is this 5%? அண்ணனுக்கு ஒரு ஊத்தப்பம் போடுங்க. Here you have 3 G spreads which are translating to C spreads. You don't say G spread, okay, that measure is different. Because we are talking about multiple rates, we are talking about G spread. Clear? Should we proceed further? Or enough for today? See, what you have to do is you have to take a bigger picture. Every time when one more concept you are adding, you have to take a bigger picture as to what exactly you are doing it. First thing, we are talking about bonds. We are calculating the yields, right? And so we have looked at different types of yield, right? That conversion is not yield. Conversion is same yield only you are talking about, one fixed rate bond, and you have one yield. You are trying to calculate yield for another and compare. That's all. That is the conversion rate we saw. Right, and then we are talking about this one, right, where different spreads we discussed, right? So different this G spread calculation and all will also come. We will discuss, but most of it is included. So here the biggest thing that we, or the most important thing that we want to understand is the G spread, right? Otherwise, calculation government spread is the actual spread for not 1 year, for one period. Okay, for let's say if it is an appropriate tenor means 10-year bond, 5-year bond. This is across multiple years, multiple periods, constant spread, zero volatility spread. These are the two main factors which we are talking about. Obviously, there is calculation for I spread also and G spread also. Probably we will look at it in the next class, and then we have this other things which come from your Z spread also, which we will look at in the subsequent class. So the point that I was telling is you have to see like how different concepts you are calculating. In which concept, which functions we should use. That you should make a note. This will build on. We have another 7-8 modules for working with calculations, formula, intrinsic. So you should make a note for yourself for this particular type of calculations. I should use this function. These are the points I should make note of. That RHS to LHS, that notations I should remember. Now, should you memorize all these things? Not required, right? That notation, that hint I gave, so that it becomes easier for you to understand. The more you practice using that, it will automatically come to you. None of these things you have to remember. You don't have to remember this APR formula and all. The more you practice, automatically it will come. The most important thing that you should make note of is this part. Okay, using how to calculate using this way. Right? How do I use my this? Where is that formula? A is equal to T into 1 plus R. This formula, how I understand. This is what is working across. Okay, fine. So see that you are going through. Work out the questions that are there in the material. I have not taken any of the questions. So the examples are all very good, right? In your learning module 7. I hope till 6 you have completed. Right? Any doubts till 6? No, so I hope you have completed those, right? See that you are completing 7 also. We will try to complete 8 and 9, not 9, but 8 and some of the workings we will do tomorrow. All right, fine. We'll catch up. Thank you.